Welcome. This is Master Lease and Option video tutorial number 1. My name is Jeffrey Smith. Disclaimer. The information provided is for general educational purposes only. It is intended to provide accurate and authoritative information with regard to the subject matter. The providers are not engaging in providing legal or accounting advice or other professional service. If such advice is required, then the services of a competent professional should be sought. This is not a solicitation of investment securities. Objectives. Prerequisite. View the main presentation for the Introduction to Income Valuation and Syndication course, available at http://bit.ly/ITIVAS-1 to learn about structured financing and income valuation. Learn how the Master Lease and Option MLO is a form of seller financing. Learn how to calculate the valuation of the MLO. Generate a letter of intent LOI for the MLO. The Master Lease. The Master Lease Agreement, MLA, is a contract between the property owner, lessor, and the investor, lessee. The MLA grants a leasehold interest in the entire property with the express right to sublet the individual units, for example, dwelling apartments, standardized office units, etc., or to partition the square footage into individual rental spaces, for example, industrial or warehouse. The lessee acts like a commercial property manager and retains any cash flow above the agreed MLA periodic lease payment to the lessor. The MLA periodic lease payment could be viewed as interest-only debt service on seller financing, because it doesn't increase equity ownership for the lessee. A leasehold interest is not equity or ownership, it is only control. The MLA may be a gross lease or a net lease. For a gross lease, the lessor pays all operating expenses from the gross lease payments. For a net lease, the lessee pays specific operating expenses, which may include property taxes, property insurance, and capital expenditures, in addition to lease payments. The lessee may delegate the property management to a third-party entity and just manage the managers. A memorandum of lease agreement may be recorded on the property title. The MLA can be terminated upon meeting or failing to meet specific conditions, such as economic occupancy rates or operating expense thresholds, which means that if the income decreases too much or the expenses increase too much, you can walk away from the lease agreement. The option contract. The option contract option is an exclusive, unrestricted, irrevocable right and option to buy the subject property at a price, mutually agreed value, MAV, and terms for a period of time. Contrary to popular real estate guru teachings, the option contract does not grant an equitable interest in the property, according to the United States Bankruptcy Court. Conveyance of property title by exercising the option will grant an equitable interest, ownership in the property. The option contract requires rendering option consideration to be enforceable. Option consideration may be cash, products, or services, and it applies to the purchase price to reduce the balance due at exercise. Rendering additional option consideration will extend the option time period. All option consideration applies to the mutually agreed value to reduce the balance due at exercise, and is non-refundable unless the optionor fails to perform as agreed. The option includes an attached purchase and sale agreement, P&SA, signed and notarized only by the owners of record. The optionor escrows all notarized conveyance documents. At option exercise, the optionee will sign the P&SA as the buyer and then close the purchase according to the agreed terms. A memorandum of option to purchase may be recorded on the property title. The option may be terminated in the event of a terminated lease agreement. The Master Lease and Option. The Master Lease and Option MLO has two independent contracts: the Master Lease Agreement, MLA, and the Option Contract, Option. Each contract is independently assignable to a third party for an assignment fee. The MLA lease payments serve as the interest portion of the seller financing. The option consideration payments serve as the principal portion of the seller financing. The periodic payment can be structured just like an amortizing loan, with variable interest and principal portions, or with independent lease payments and option consideration payments. The contract terms usually run concurrently and are concurrently renewed. Lessee and optionee are named as additional insured parties. The MLO is best used for managerially distressed commercial property. Seller benefits. Retains ownership for property depreciation to shelter taxable income. Some sellers have taken out cash through refinancing and cannot participate in an IRC 1031 tax-deferred exchange. The cash out above the capital basis is immediately taxable as capital gains upon conveyance of title through a sale. By deferring the sale until the demise of the owner, the heirs can receive the capital gains on a stepped-up capital basis. The seller seeking an IRC 1031 tax-deferred exchange can dispose of the property now without incurring the time restrictions of qualifying for the exchange. If the option expires, then the owner gets back an improved property. Buyer benefits. A form of deedless transaction that reduces exposure to the liability of ownership. An excellent form of seller financing with little or no money out of pocket and no credit for bank loans. The seller is the lender. Can often negotiate applied rent credits, principal paydown, according to an amortization schedule that provides increasing benefits to the buyer compared to IRS depreciation schedule. The buyer seeking an IRC 1031 tax-deferred exchange can acquire control of the replacement property now for cash flow without immediately finding a buyer for the subject property. The subject property can be sold and the replacement property purchased in a simultaneous or double closing. Example: MLO current operating data for a distressed property. Gross scheduled income, GSI, $100,000. This is 19.35% under market rent. Vacancy and credit loss, $15,000. This is 15% of gross scheduled income. This is on the high side of vacancy and credit loss. It should be much lower. Actual rental income, $85,000, 85% of GSI. Other income, $3,600, that's 3.6% of GSI. Effective gross income, EGI, $88,600. Gross operating expense, GOE, $49,000. This is 55.30% of EGI. This is a very high expense ratio. It should be in the low 40% range. Net operating income, NOI, $39,600. The current debt coverage ratio, 1.1343. This is a very low debt coverage ratio. This is probably why the owner wants to get out. He's not getting enough income, and he can't qualify for a refinance. The blended annual interest rate of the first and second mortgages comes to 7.1867% in this example. The primary amortization term is 216 payments. That's 18 years. Blending the debt constants for the first and second, 9.9177%. The blended loan-to-value ratio for the first and second is 80%, and therefore the equity-to-value ratio is 20%. Leverage to debt is 4.0. That's 80% divided by 20%. We've chosen a capitalization rate of 9.0%. And thus we conclude that the gross return on equity, the ROE, which is also called the cash-on-cash return, 5.3292%. The capitalized property value, CPV, is $440,000. That's the net operating income divided by the cap rate. We then subtract the blended debt present value of $352,000 to arrive at the effective equity for the owner, $88,000. Net operating income, $39,600, subtracting the blended annual debt service, $34,910. We calculate net cash flow before tax, NCF, of $4,690 per year. That is less than $400 per month. With these parameters, it's no wonder that the seller wants to get out of this property in some way that he doesn't lose his shirt. MLO Pro-Forma. This is what we, as yet unrealized, expect to improve the property. We expect the GSI to increase to $124,000, a 24% markup on the current GSI. This will be market rents for all of the units. Vacancy and credit loss, 11,160. That's about 9% of GSI. Actual rental income, 112,840, 91% of GSI. Other income, 3,720, 3% of GSI. Effective gross income, EGI, 116,560. Gross operating expense, GOE, 52,000. That's more than the previous example, but the percentage of EGI is less. Probably we are not deferring maintenance. We're responding better to tenant repair requests, and that's why we can charge higher rents, and that's why our cost of maintenance and repairs is going up. Net operating income, NOI, 64,560. Debt coverage ratio, DCR, 1.6303. Blended annual interest rate, we'll structure this as two seller finance notes, a first and a second. The blended rate is 7.6687%. Amortization term, 300 payments, that's 25 years. The blended annual debt constant, ADC, is 9%. That has to match the capitalization rate for the current operating data. Blended loan-to-value ratio, 70%. Equity-to-value ratio, 30%. We're creating 30% new equity in the property. Leverage to debt, 2.33. The derived capitalization rate is 10.2709%. Notice that the cap rate has gone up, which generally implies a reduced property value. However, our income is also going up, which outpaces the increase in the cap rate, and therefore the property will be worth more than what we agreed to pay for it. The gross return on equity is now a healthy 13.2364%. The capitalized property value is now $628,571. Subtracting the debt present value of $440,000, the current capitalized property value, what we owe the seller, means that we have created equity of $188,571 just by managerially improving the property. The annual debt service, $39,600, matches the current net operating income. We then subtract the first year principal paydown as option consideration, and therefore the first year interest was $33,532, which represents the master lease payment portion. Our net cash flow before tax, NCF, is now $24,960. That's over $2,000 a month. This is all calculated from a spreadsheet, the Master Lease and Option sheet, that is available in the Introduction to Income Valuation and Syndication course. On the left side is a column where we input the current operating data and current debt structure. And on the right-hand column, we input the anticipated pro forma operating data and debt structure that will wrap the current debt and the owner's equity. From this spreadsheet, you'll be able to generate the letter of intent. The letter of intent, LOI, is a professional, non-binding proposal like, what if we did this deal together? It's generated in seconds by Microsoft Word 2007 mail merge template with a few point-and-clicks or keyboard shortcuts. The mail merge template can be saved in your templates folder with your signature inserted as a JPEG image. The mail merge document extracts the data from the Microsoft Excel 2007 spreadsheet, Master Lease and Option.xlsm. All of the structured financing parameters are populated into the mail merge document. The populated mail merge document can be edited as needed and then saved as a PDF file for email. Introduction to Income Valuation and Syndication. The Excel 2007 spreadsheet and the Word 2007 mail merge template are included in the Introduction to Income Valuation and Syndication course. Learn how to calculate the income valuation of a property with structured financing. Learn how to get paid to buy income property with other people's money, OPM. Includes sample master lease agreement. Includes sample option to purchase agreement. Includes Excel 2007 spreadsheets for financial analysis. Includes sample forms and other contracts. Go to this link right now, http://bit.ly/ITIVAS-1 for more information on this course, Introduction to Income Valuation and Syndication. This has been Master Lease and Option video tutorial number 1. My name is Jeffrey Smith, and thank you for your support.